I encourage, companies, regardless of where they're at with their individual program, to, investigate captives and to learn about it and spend the time to talk to an expert to learn what they're all about. Because what I've found from having a lot of those conversations is that employers usually, even if they're not ready for it today, they end up feeling like they're really glad they learned about it and something that they actually want to work towards and start doing the things that are going to set them up to be able to join a captive program and be successful in it.
Hi, and welcome to Captivating Health Insights. This is episode number 3 of our mini-series on captive education, and today we're talking about captive structure. We are building upon episodes 1 and 2 with Dave Gillis and Joe Pirelli, where we talked about moving from fully insured to self-funded and the difference between traditional and captive stop-loss. I'm very excited to welcome Kevin Hallen, Managing Director of Health Solutions here at Captive Resources. Welcome, Kevin.
Thank you, Madison. Very happy to be here.
I'm excited to hear your first time on the podcast, so welcome.
That's right.
We're going to break down all things captive structure, and we get a ton of questions on this, so I'm excited to dive in. But before we do, tell us a little bit about yourself and how you got to where you are today.
Yeah, I've been at Captive Resources for 15 years now as a captive executive, so one of the folks that helps work with the board of directors of the captive and lead the team that is supporting each of the captive programs. So I've been doing that for 15 years now, as I said, and had experience both on the casualty side and on the health captive side now for many years.
And a lot of our employer groups, they may be in a casualty captive or a health solutions captive. And so it's nice because you have the perspective of both, right?
Yeah, and it's been a really nice tailwind for our program, for the captive programs that we consult on, because really the reason that we got into it in the first place is that we had members on the casualty side who were really happy with what we were doing for them on that side of the street and what those programs were doing. And, they were really looking for a solution on the health insurance side that was going to give them some of the same benefits. So,
which is such an interesting impetus to the program that it's that effective, where the casualty members were saying, hey, this works so great. Can you do it on the health insurance side? What can you do for medical stop loss? And it's just a testament to the success and the efficacy of the programs.
For sure. And the biggest question we get from casualty members is, on the casualty side of the street, we're able to, get new personal protection equipment, put in new safety practices, hiring practices. There's a lot of things we can do to directly prevent costs from happening. On the health side of the street, you can't totally prevent somebody from getting sick, right? Unfortunately. And so while there are some ways to try to catch stuff earlier, a lot of the important thing for them to understand is that the focus becomes, how do you impact costs once people do get sick? And how do you, help your employees become better consumers of healthcare and make good decisions that are going to be good for them and for the company?
Mm-hmm. Yeah, because you can't stop every claim from happening. You're going to have claims, but how do you manage those claims?
Exactly.
Yeah. So let's start at the most basic level for those that may not be as familiar. What is a captive in its most simple terms?
Yeah, so a captive is an insurance company, and more technically a reinsurance company. So when you join a captive program, you're really going into a self-funded model where you have a A or A plus rated stop loss carrier, a big insurance company that is providing a stop loss policy that's going to look, smell, taste, and feel just like any other stop loss policy you'd get in the traditional self-funding space. The difference with a captive is behind the scenes then, they reinsure a layer of that risk above a chosen specific deductible level of risk that the employer wants to take on. And the captive reinsures the stop loss carrier for that risk. And so in exchange for that, the stop loss carrier cedes down a portion of that premium to the captive, which the members get to invest and ultimately retain the profits from based on their good performance.
And is it true, you've seen one captive, right? And that's what we're really digging into today. There's so many different ways, right, to structure a captive?
That is very, very true. There's a lot of different flavors of captives out there. the programs that we consult on are what I would call a true member-owned program. So they're 100% owned by the employers that are shareholders of that captive. And the nice thing about the member-owned approach is that because you're an owner, you get transparency and you get real control over all the different aspects of the program.
So what are the different components then of a captive? Reinsurance, pooling layer, governance? How does all of that work in terms of captive structure?
So being a member-owned program, each of the captives has a board of directors that is made up by the different shareholders. So each employer nominates somebody from their company, one person, to be a director on the board of directors of the captive. And they are then able to vote. They get together once per year to vote on all of the issues that are coming up for the captive. So they really get to, have full transparency into the financials of the captive and also make decisions about, the structure of their captive, what types of companies they want to be a part of it, et cetera.
Okay. And what do you think people most commonly don't understand about how the captive functions in a member-owned sense versus other captive structures?
Yeah, I think the thing that people value the most is that transparency. Because if you don't have transparency into what's going on with your captive, it's hard to really understand where all the dollars are going. Are you getting profit distributions that are appropriate for your portion of the captive? And we see these members, these employers that become captive owners, become really, really sophisticated and really knowledgeable about these programs and do a really great job leading the direction of their captives over time.
Mm-hmm. So for an employer that is maybe new to a captive or they're looking into it, how would you help them understand the different layers? Because we talk about the layers of the captive, and I think that gets confusing fast. So how would you kind of, in simple terms, explain those different layers?
Yeah, so there's two main types of captive layer structure that we consult on. The first would be a pooled captive. So in a pooled captive, you're really using that captive layer as an insulating force to try to kind of share risk with your partners and smooth out your returns year over year. And so in a pooled captive, you're able to get profit distributions back, but they're going to be more based on the performance of the overall group. The other type of program is called the risk-reward captive. And in a risk-reward captive, each member gets to benefit first and foremost from their own performance instead of really, primarily being based on the performance of the overall group. And so they're still backstopping each other. They're still protecting each other from a significantly bad year. But for members that are really looking to get the most potential profit and the most, the largest dividends back from their good performance, the risk-reward program might be a avenue they'd like.
And is it fair to say that the pooled approach is maybe less risky and less opportunity for like reward, and the risk reward is a little riskier with more return potential? Or how would people kind of understand the risk tolerance differences?
Yeah, I think that's fair enough. I'm not sure I'd say it exactly that way, but the risk reward model definitely is going to have a wide array of outcomes for people that really feel like they have it all locked in and they really want to bet on themselves. It gives them a great opportunity to, get the most profit potential. And you're in there with a program with people that kind of have that same incentive structure and are really looking to do everything they can to impact claims. So you really feel good about the culture of the program. That being said, keep in mind that 80% of the costs, even in a pooled program, is within their specific deductible, right? So those folks are still doing everything they can to control claims and have a big impact on their first dollar costs, which is really, the main priority of all types of group captives. And so, it's not that they aren't trying to really impact claims. They really are.
Right. And how does an employer decide what kind of approach is best for them in terms of kind of choosing which path to go down? Yeah,
this is where education is so key. And so, if somebody's considering looking at a group captive program, really encourage them to, meet with their benefits consultant, bring in somebody from captive resources that can help educate them and really talk through the nuances of their individual situation, help give them a feel for the different options that are out there. Because really, one size does not fit all when it comes to captives. Employers have very different situations, very different needs. And so, the programs that we consult on really try to meet employers where they are with their specific needs.
Mm-hmm. And how would you describe like the risk layers of how, what there's an employer responsibility and then there's a captive layer. Right. How does that sort of giving them that extra layer of protection as they come into the captive?
Yeah, so I would say it's giving them similar protection to a traditional self-funded program, right? So they're going to choose a specific deductible level where they're going to retain the risk accumulated for each individual per policy year. Once they hit a certain threshold, at that point the stop loss carrier is going to start reimbursing them for claims, and so they're going to have that same protection. They're also going to have protection on an aggregate basis for a lot of everyday claims, first dollar claims. The nice thing about the captive is really it's going to help them bend that cost curve when you get to renewal each year. And so what we see is that the group captive programs actually outperform the traditional stop loss market from a renewal standpoint. We see meaningfully lower average renewal increases, and we hear from the stop loss carriers that work with captives that they're seeing those groups outperform. And so when we go to renewal each year, the nice thing for the member company or for the employer is that they're able to, one, get the benefit of that outperformance in their own as kind of the baseline for their renewal, the kind of the trend for their renewal. But then these programs are priced individually, so we're also ensuring that each company is going to be priced appropriately for their risk. And when I say we, it's really the underwriters that are working for the program, but they're going to make sure that each member company is priced appropriately for their risk while still getting the advantage of the better performance of the group captive.
Mm-hmm. And just to kind of help put numbers to it for people, like what's like a typical spec layer or level that you'd see, and how does it kind of break down in terms of number wise?
Yeah, so we see anywhere from 25,000 specific deductible up through 500,000 or more. I'd say probably the sweet spot is somewhere in that kind of 40 to 50 up to 200, 250, where we see the most activity from a specific deductible layer. But again, these programs are set up to fit a very wide array of different companies, from 50 enrolled employees on the plan up through 4,000 or 5,000 plus employees on the plan.
Mm-hmm. That's awesome. And in terms of benefits of the captive for members, with Joe, we talked a little bit about community. Mm-hmm. With Dave, we talked about just the financial stability. What else would you add in terms of like the benefits that you hear from members as they have years under their belt in these captives and more experience?
Yeah, so those are two really important ones, and I would certainly echo those points. I think the structure of the captive gets you further away from the traditional insurance market, and so the pricing mechanisms, we're hearing a lot about a hard market and stop loss right now. That isn't impacting the captives that we consult on in the same way that it is, companies just in the traditional market. So, a big chunk of the stop loss exposure is being priced based on that captive performance. Whereas we still have excess protection for large claims, and we're still buying, reinsurance from those stop loss carriers. But there's a different level of exposure to that traditional market by having that captive layer in place, and being able to benefit from the results of all those efforts that you mentioned, from a cost containment standpoint, and really sharing ideas about best in class pharmacy strategies and other cost containment approaches.
Mm-hmm. That makes sense. So they're a little bit more insulated from some of those, like the volatility that can happen more so in the market. Obviously nothing's, foolproof, right, but they're generally have more protection kind of baked into the captive layer.
Exactly. So they're just, again, the amount of risk that is exposed to the traditional market is less because they're taking risk internally as a captive.
Mm-hmm. So Kevin, what drives the opportunity for dividends to be distributed, and how does that kind of profit sharing work within our captives?
Yeah. So again, it's different depending on the type of captive layer structure that you have. So for a pooled captive, everybody has a portion of their premium that gets allocated for their loss fund, so dollars that are going to be available to pay for claims. But then those dollars get bucketed together amongst the entire captive. And so if the group overall the group overall's performance is going to dictate the profits that each member gets back. So if the group overall has 10% of the loss fund for the entire captive left at the end of the year, each member is going to get back a distribution for 10% of their individual loss fund portion of their premium. From a risk reward standpoint, there's actually a buffer between me and the other members before that risk sharing really comes into play. So there's a chance for them to actually pay in a few additional dollars if they have a bad year. But what they get for that is that's a buffer, again, between them and the other members. And so the impact of sharing across those members is going to be a lot less. So you might see a member in the same policy year, one member gets back 70% of their loss fund because they had a great performance, where another member isn't getting back any dollars at all, or maybe has paying in a couple of additional dollars.
Because it's more, with that pooled approach, it's more on your individual performance, you're saying?
The risk reward approach is more based on your individual
so
performance.
You have a
correct.
Greater reward. You have the opportunity for a greater reward if you're
Correct.
individually performing better that year.
Correct. So if you're looking to just have that stop loss layer be more consistent from a cost standpoint, pooled structure might be a good option. If you're looking to really maximize the dollars back, year to year, then in those individual years, that's where that risk reward model could be a good fit for you.
Gotcha. And what would you say with our captive resources, captive structure specifically, what's maybe different or unique as compared to what other captive arrangements that people may have seen out there in the market?
Yeah, well, I know the things that we really pride ourselves on with the captives that we consult on are, one, I talked about true member owned, and that brings a lot of things with it. The transparency, regular profit distributions, also open architecture. So while we have a group called Strategic Partnership Solutions, which their whole job is to go out and find really great vendors that captive members and their benefits consultants can access and add as part of their strategy. There's no specific mandates from the members. The members have not chosen to make specific mandates for their fellow shareholders. And that's because, each company has their own situation, right? They're in a state that has very specific needs, their pharmacy approach, what's going on with their population. And so that open architecture really allows each member to pick the strategy that's going to be the best fit for their individual circumstance. Now, open architecture does not mean that there isn't a commitment to cost containment. And so certainly, workshops, board of directors meetings, there's a ton of best practice sharing and really a huge focus on putting the right pieces in place to create that vendor ecosystem that is going to really allow these employers to perform incredibly well and really keep costs down.
Yeah, and I hear it all the time that open architecture structure is just huge, because that allows people to, like you said, they're still doing cost containment. They're incentivized to, within the captive, but it allows them to choose the solutions that they want that do align with their philosophy or their strategy. And so we're not kind of boxing them in anywhere. But like you said, our SPS team, which I sit on, some people wonder what I do as another part of my job, besides this podcast on the SPS team, Strategic Partnership Solutions. It's just an awesome option to have different solutions that we already, have negotiated pricing and terms and conditions, and you can choose whatever solution you want. But if you're looking for a recommendation, and a connection, it's there for you. So really just get a lot of feedback on the fact that it's not only open architecture, but then there's also recommended strategic solutions as well.
Yeah, and our benefits consultants have a lot of strategies and tools at their disposal, some that are really unique to their organizations that we want to make sure that members can access and take advantage of. And of course, SPS, has been a huge benefit to our members and our benefits consultants. We've seen, a lot of enthusiasm around the strategies they've been providing as well.
Yeah, and would you say, is there an opportunity, or is there a situation where maybe a captive doesn't make sense if, an employer or broker is kind of going down the path, and, are there times where that comes up?
Well, as much as I would love to say that everybody should be in a captive,
never is the answer.
No, there certainly are, right? And again, these are member-owned programs, so the members want to make sure that people that they're bringing in to be a part of their club are going to be high-quality companies that have a good trajectory for success and to be a good addition to the program. And so. So certainly there are times where claims are not looking great, and the employer is going through some tougher things that they need to address and get sorted out. And it might just not be the right time. That doesn't mean that is never a good fit for that employer. It just means that they have to get their house in order a little bit before they'd be a good fit to add to the program. Mm-hmm. Other little things, if they're looking to sell their company in 2 months, probably not worth going through the whole process of joining a captive, right? But But the one thing I would say is that, I encourage, companies, regardless of where they're at with their individual program, to, investigate captives and to learn about it and spend the time to talk to an expert to learn what they're all about. Because what I've found from having a lot of those conversations is that employers usually, even if they're not ready for it today, they end up feeling like they're really glad they learned about it and something that they actually want to work towards and start doing the things that are going to set them up to be able to join a captive program and be successful in it.
Mm-hmm. So for those employers thinking about it, what does it look like from a timeline and sort of a step-by-step process as far as what does that look like for them that they need to think about?
Well, the first thing is, there's never a bad time to start that education process. So if you're learning about a captive for the first time and it's 2 weeks before you're, signing up, you're making a final decision on your stop loss, that's not the ideal way to do it.
Yeah.
You'd rather start early, learn about it, make sure that all the stakeholders within your organization are comfortable and understand what that entails. And then, normal timeline from a quoting standpoint, you're going to get a quote from the captive and be able to evaluate that, work with your benefits consultant to see, how that fits into the overall landscape of your options. If you do decide to move forward in a captive, and I'd highly encourage in that evaluation process, if you're interested, happy to provide a reference from a company that's already in a program today, mm-hmm. and they're usually happy to talk with you directly one-on-one and just talk about their experience in the program. Mm-hmm. But then once you bind coverage in the captive, there's an onboarding process, and it's pretty simple just to get everything bound and move forward with the captive. And then there's an onboarding process in terms of getting all of the pieces in place. There's a little bit of capital when you join a program because you are buying a share of stock in that captive program. And so there's a little bit of process on the back end to get you in. We try to have a nice, robust onboarding process to make sure that once you do come into the captive, you know all the different tools that are available to you. You know how the captive operates and what kind of the key timeline and dates are.
Okay, so there's the collateral, like you said. There's obviously kind of the paperwork and anything else in terms of like data or kind of those first steps in making that transition.
Yeah, so the first step, you're going to sign the stop loss proposal. That'll get going for an application that you can sign to actually bind coverage in the program. There's a capitalization to stock purchase in the captive. You're going to post a little bit of collateral. That's, we talked about making sure the captive is protected. So these programs are well capitalized. We're making sure every member is putting up a little bit of capital to make sure that the program and their fellow shareholders are protected. But then after that, there's really not a ton of work into actually binding your policy. Each member does pick a director to sit on the board of directors of the captive. And so there's some paperwork associated with setting up your director, who's really your voting member within the captive. But we're certainly there along with our sister company, Kensington Management, to kind of help hold your hand and help walk you through that process. And it's not too bad.
Mm-hmm. And then once you're in the captive, just give people a flavor for what that community looks like, as far as like, okay, are there webinars? Are there, like, what does that look like to come together in person? I know you use the board of directors, like, just give people a flavor for that.
Yeah. So there's a lot once you're in the captive, right? There are monthly webinars, workshops that are held once per year, where members can send, more than one person, that's involved in their healthcare program. Benefits consultants are a part of that. We're having speakers, breakout sessions, member best practices sessions, where people can just talk to each other one-on-one. That's some of the most the things that people like the most. So there's for folks that want to be more involved and help lead the charge a little bit within the captive, there's opportunity to be a part of what's called an executive committee and lead different committees within the captive and kind of help set the agenda for the program. And then we have there are portals for the different captives where members can post questions, share ideas. There's a ton of resources on there. So we're always trying to think of new ways to support members, to support our benefits consultants, and help members continue on their journey to have the best health program that they can.
Mm-hmm. I think that's helpful. And as we kind of think about like winding down here, what is the mindset shift that sometimes you kind of see happens here when we're moving from fully insured, or even they're already self-funded, but they're moving into the captive? How do captive members think about this differently?
It's a great question. I think employers go from sometimes feeling like health insurance is transactional and just kind of the health insurance is about seeing if we can get the lowest quote each year, to really taking a long-term strategic approach where they're thinking about, how do I actually impact costs? How do I engage with my employees? What are strategies that I can use to really understand what's going on with my population? There are data analytics providers that are embedded within these captive programs, so they can really run some detailed analysis on their individual data. And it becomes that longer term strategy. I think even from a renewal standpoint, instead of just kind of like blanketing the market and trying to get a cheap quote, it really becomes about understanding what's going on with that individual employer, trying to get it right. If there's a large claimant that's out there, the underwriters are going to work with their benefits consultant to understand what strategies are they implementing to try to impact the cost of that large claimant. So the result of having that consultative approach is that we've seen our programs have the captives that we consult on have a really high retention ratio. So we're typically renewing about 98.5% of the members. It's pretty rare for someone to go back to the traditional market, and a lot of those are companies that are sold. So,
right.
So I think that is really a testament to that consultative approach, and the members really like the benefits they get within the captive.
Mm-hmm. Yeah, and I think one of the things I hear, the questions I get in the approach too, is even thinking about the no new lasers approach with the rate cap. Is that something you can expand upon as well?
Yeah, so that's a nice benefit of captives, is many of them have what's called a no new laser contract with a rate cap. So they're basically saying, in traditional stop loss, if you don't have that provision in place, they can add a higher specific deductible or a higher individual deductible for someone that has known costs going into a year. So a no new laser contract basically says we're not going to add on any additional deductibles. And that can be, it could be a sizable amount that you could see. So the rate cap then says, that special deductible isn't very helpful if we can just jack up your premium by, 3,000%. So it actually limits the amount that the premium can go up. One thing that we've seen with employers is that while that rate cap is really important and it's good to have in place, oftentimes there are individuals that they are putting strategies in place for. And so sometimes they don't want to take that rate increase. They would rather actually choose to use a laser strategically, keep their rate down for future renewal increases. And oftentimes they're able to do things to impact the cost for that individual that they don't even end up, paying that laser. So that's one additional strategy that our members really like.
Mm-hmm. Again, just one example of the different strategies that you can put in place to manage these costs and impact the overall cost of your healthcare claims.
Yep.
So, Kevin, I asked Joe and Dave this question too, but where do you see captives going in the future? How are they going to evolve 5 to 10 years from now?
Yeah, I think that having seen captives evolve on the casualty side as well, we've really seen them go from kind of a niche solution to really mainstream and really being one of the defining solutions for middle market companies on the casualty side. And I think that there's a good chance that we're going to see a similar trajectory here. We're already at a place where group captives are very popular, and there's so many employers that are hearing about them, that are investigating them for the first time, or folks that have been in them now for a little while, that I think it's going to be a really integral part of the overall fabric of the health insurance space going forward.
Mm-hmm. Any last thoughts as we close out here for our listeners that you want to make sure to share, Kevin?
Well, I'll start just by thanking you for having me, and appreciate the chance to come chat with you today. I would just say for folks that are thinking about, entertaining, exploring a group captive, talk to folks that are leaders in other businesses. If you're interested, you can reach out, and we can always get you a reference for somebody that's been in one of these programs. I think it's one of the best ways to learn about these programs is to talk to somebody that's actually had experience in them, and hear what their journey's been like. So I'd encourage everybody to consider that. Yeah,
I think that's great. Hear it for yourself. You have a colleague or met someone, like you said, we can set you up. But I think that's the best and easiest way is just, what has been your experience.
Right.
So
Absolutely.
Love that. Well, thanks for being on the podcast today, Kevin.
Thank you so much, Madison. It was fun.